Thank you very, thank you very much, Andrew, and welcome to everybody actually on site. I'm going to do just a quick little introduction of the speakers, and then we'll get right to it. So we have a good combination of private equity representation, investment bankers, and on the investment side as well. So starting with Ross Bhappu, who heads Resource Capital, one of the more recognized mining private equity houses out there. And we have Kate Southwell, who is General Counsel at Pala Investments. And certainly Kate, in addition to her private equity focus, has actually sat as a director and general counsel on a number of the public portfolio companies. Then we have Pascal Lussier, a banker with BMO, who has been very busy on the M&A side this year. And to round out our panel, we have Mark Burridge of Baker Steel, and he's going to give us the fund management perspective on all of this. So, to begin with, we're going to cover four major topics for this presentation. The first is generally the very healthy trends in the overall global mining M&A market. The next is battery metals and what's going on in that space. Then we'll talk about the impact of ESG. And finally, we're going to talk a little bit about the increased activity that we're seeing from Chinese acquirers in the market. So starting with just the general, really strong and great environment for mining M&A, I'm going to start by asking Pascal, from your overall investment banking perspective and what you and your colleagues have been working on at BMO, how would you describe the current state of the M&A market and where it's going over the next year or so?
Yeah, thanks. Thanks, Mike. I think if you look at, obviously this year, it's been a very strong M&A market, probably as strong as we've seen in many, many years in the mining space. I think in particular, if we're looking at battery material or battery metal, and including in this kind of lithium, cobalt, nickel, copper, we've seen this year in 2021 at least 25 transactions of scale. Again, yesterday we saw the combination of Capstone and Mantos Copper. So very, 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 very strong in that on that side. On the precious metal side, I think M&A activity has continued, and I think what we've seen since, and that really started all the way back in 2018 or 2019 when Barrick and Randgold merged. What we're seeing still in the gold space is a continuation of consolidation transactions. So, producers merging with each other and consolidating. We've seen that with Agnico and Kirkland. We've seen that more recently with Newcrest buying Pretium. So that's really what we've seen in the gold space this year.
Ross, from your perspective, in terms of what you're seeing at Resource Capital and otherwise your views on the market, how would you comment on the situation?
Now, look, I think from our perspective, 2020 was a slow year for us to be actively buying and acquiring new assets. I think the challenge was really on the due diligence side. It was getting teams out to sites. So conducting due diligence was a challenge for us, but I think we sort of figured out how to get around that. We do have offices all over the world, so we were able to tap into different groups, and that helped. Also doing virtual data rooms, virtual site visits has helped. But for us, nothing beats getting on the ground. So from an M&A perspective, I think 2020 was fairly slow. but 2021 has certainly picked up, and the activity we're seeing is, I think it's amazing given sort of the situation we're in and the difficulty it's been traveling this year. So, no, look, I think definitely it's picked up in 2021, and we're excited by the deal flow that we're seeing.
Thanks, Ross. I'm going to turn to Kate now. And Kate, in terms of where you sit, how do you see the environment playing out in 2022?
It's a great question, Mike. And unfortunately, none of us are able to attend. And I think the conference today speaks to the way we'll be working through the rest of the year and beyond. We need to be very flexible. And I think the uncertainty and volatility that we've seen this year looks set to continue. But as Ross said, people are working around this. It has not slowed down the tremendous amount of deal making. And I certainly think that appetite will continue to be shown through 2022. Metals prices are high and demand is incredibly strong.
Thanks, Kate. Turning to Mark. Mark, from the investor vantage point, how do you see the market, and what do you think investors want to see in terms of the type of M&A activity into 2022? And please comment on your views of how financially disciplined and sustainable you think it's going to be.
I don't think we can hear Mark.
I can't.
No. So let's.
Yeah. So
Mark, are you with us now?
Perfect. I'm with you. Yes, great. Now I'm encouraged by the discipline shown so far in the M&A that we've seen, and certainly certainly different investors have different perspectives on it. Our perspective is that too much capital was destroyed with bad M&A in the previous cycles. And we think it's much healthier for the business to maintain this disciplined approach. And what we're seeing is that companies who want to find a way to do smart deals, such as Agnico and Kirkland or Barrick Randgold or just overnight Northern Star Cisco Mining, do find a way of doing those deals, and they wait for the stars to align in terms of share prices. And so I'm actually encouraged that companies are finding a way to do deals despite the volatility and disjoin in commodity prices right now. So I think that's going to continue coming into next year. And we certainly get a sense that the majority of the sector are going to maintain that discipline and go for low premium mergers or mergers of equals or smart deals such as earn-ins and joint ventures. And I think that's quite encouraging. Of course, there are going to be some of the emerging producers that will deserve to get a premium takeover price if they have the right asset in the right jurisdiction that has the right risk profile. I think that the other thing which will perhaps add to the complexity of doing M&A over the next year, though, are two factors. ESG is one. I know we're going to talk about that next, so I won't mention that. But I think the other thing which is sort of a two-edged sword is inflation. So of course we're all positive on inflation in terms of what it might mean for commodity prices, in particular precious metals prices, in terms of being a macroeconomic driver there. But I think there's going to be a lot of uncertainty as to which companies can better manage inflationary pressures, and that's going to come down to companies that have got the tools to be able to do that, and perhaps less exposed to the big capital cost and supply chain issues that are probably going to be bigger drivers of inflation than maybe some of the normal operating costs. So I think companies are going to have to work around that issue. But I think we'll see more next year. I think certainly as investors, we're encouraging companies to do sensible deals.
Okay. Thanks, Mark. There's one point that I want to come back to Pascal on. Mark, your comments were really centered on financial discipline in these transactions. Certainly not every deal can be done at a low or no premium. Pascal, what do you see in the pipeline? At what point are we going to start to see at least some movement back towards the more historical premium mergers and some cash deals?
It's a good question. It's a good question, Mike. I think Look, I don't think necessarily that premium transactions don't exist anymore. What I think has happened is the range of transactions that are acceptable to do as a low premium has increased, meaning that you could in the past, if you were a company, you acquire another company, you're going to own 70% of the pro forma company, you would be expected to pay a premium. While I think today it's much easier from the target perspective to accept a transaction where even if you own, let's say, 30 or 25% of the pro forma company, to accept a lower premium, and then to also speak to your shareholders, and the shareholders will accept more that the value will be realized over time through the combined entity being capturing synergies and being valued at higher multiple. So I don't think necessarily it's a question that's gone away. I think it's just a type of transaction where it's acceptable. Probably the universe of that has grown. I still think that if Barrick wants to acquire a developer that they're going to pay $500 or $1 billion for, they're still going to have to pay a premium. I don't think they're going to necessarily get away with being able to do these transactions at a very low premium. And ultimately, maybe to put it back to Mark, interesting to get your view. Ultimately, it also depends on what their shareholders are telling them, right? Like if a company who's getting acquired is going to be 30% pro forma ownership and doesn't receive a premium, if their shareholders are supportive of that and are willing to say, look, we're okay not taking a premium today, we're okay to realize our premium over time, these deals are going to continue, right? Like it's also going to be driven a lot by what shareholders want.
Yeah.
So moving to another area where we certainly do see premiums and a lot of exuberance has been battery metals. And that's obviously a broad family of copper, cobalt, nickel, lithium. And we've seen some transactions especially play out in the Canadian market that really show the premiums there, whether it's the Zijin acquisition, which is pending, of Neo-Lithium, the takeover battle for Millennium Lithium that's just occurred, and the continued sort of fight over Noront between BHP and Wyloo has really shown there's a lot of activity in that space. And it's really also been almost blown apart because it's not just the traditional players who are in battery metals, but you start to see precious metals companies, primarily, whether it is Sibanye, whether it's Zijin, expanding into this battery metal sector. And you see end users, whether, for example, cattle and others who are going directly into the mineral, as well as the traditional industry participants. So it really becomes a three-way competition for transactions. And certainly there's SPACs as well. I'm going to call on Ross to begin with, because Ross, I know you have some views on what you think is going to happen in this sector.
Well, look, I don't know that I have a crystal ball, but I think what is amazing to me is the exuberance, the number of companies that are looking for targets, looking for investments in this space is really quite astounding right now. Just looking through various rags yesterday, there's 6 SPACs that are dedicated to battery minerals that are out looking for opportunities. We've got one, as I know others do, but it's a very active space. There's a limited number of opportunities, and there's a lot of people chasing it. So we're starting to see, or we have seen, I think, some very strong valuations, and so I think when we look at it, or when I look at it from my perspective, you've really got to look at what is the true value add, what is the value creation aspect. When we look at supply and demand characteristics, the demand for these battery minerals is continuing at an incredible rate. the articles that came out overnight last night, just BHP talking about the need for 2 times the amount of copper that's currently existing over the next few years. Nickel, 4 times the amount of nickel to meet the carbon goals by 2050. There's a massive amount of demand for these minerals, but there's also a lot of money chasing these opportunities. So it's an interesting time, an interesting perspective that we're in. And look, I think it's an exciting time to be a part of this, but I think you got to do your homework to find the good value, and that's the key for us is finding good value opportunities, and so that's where we're focused on.
Thanks, Ross. I want to ask Kate now, because Kate, certainly over the last few years, together we've been involved in a number of battery metal plays, and you continue to be very active at Pala in that area. Based on your experience in those transactions, Kate, and what you guys are kind of looking at down the fairway, what do you think people are going to focus on and sort of the hot areas over the next year?
Yeah, thanks, Mike. Well, I mean, as panelists have pointed out, I think lithium at the moment is generating all the headlines in terms of competition. And we start to see that shift now towards perhaps nickel and copper. And I'd like to add tin as the unsung battery metal, having a stellar performance this year. I think we're at 39 today, and the tightness in that market is just unprecedented. So as Ross said, tremendous demand for these commodities. If you look at the commitments that companies and governments are making to their net zero targets, there is only one way to achieve that. And that is, as you say, through growing this pipeline and people becoming bolder, I think, in both the targets that they're looking at and in particular the jurisdictions that they're looking at. We understand that BHP is looking at the DRC. People will have to be more creative. And to jump ahead to what we're going to talk about soon, I think that creates itself a whole load of ESG considerations and concerns for both shareholders and management alike.
And turning to Mark now, from a fund manager perspective, what are you looking to see in terms of transactions in this space that you think make sense? What are the characteristics of those transactions? And do you have a preference for which of the main metals is going to offer the most M&A opportunities in 2022?
Yeah. Well, we certainly recognize that there's going to be multiples increase in demand and production needed for most of these key future-facing metals, and we're right in the middle of that because I know we're famous for gold, but we have our Electrum fund as well, which feeds into that. And I think it's all of the above. We're seeing nickel deals, we're seeing copper deals. Lithium is perhaps a little bit of a different one. We've seen lithium deals last year, so I think it's all of the key metals that are going to need to grow in supply by multiples over the next few years. And there's a real risk there in terms of, for the acquiring companies, in terms of the quality of some of these assets, the ESG attributes of some of these assets, and exactly how you put value on that when aspects like the capex and opex aren't really properly understood. But nevertheless, I've got to see, if you see one segment of the metals and mining industry that's going to generate the kind of big premium deals, you've got to think it's the selected number of those emerging companies or emerging projects in the space. And I would say it's across the board. And to put that in context, if you look at the valuation of the downstream end of this sector in terms of the value of VW's battery division or Tesla or cattle, and the importance of these minerals to those companies and the rating that those companies trade on relative to mining companies, it only takes a marginal foray of those companies into this space, as Ross alluded to suddenly up the ante in terms of what these producers are called. And I don't wonder if at some stage down the road, it's not the junior emerging companies that get taken over, but maybe some of what we as miners think are large established companies But in context of the broader financial markets, actually minnows in market cap in market cap terms. And so I wonder if we're not going to see potentially deals across the board as end users scramble upstream to secure their supply chains to meet these carbon targets across the board.
I think that's a particularly interesting point, Mark, that we often wonder about when you see the end users jump in, who are not traditional miners, jump into these situations for obviously very, very strategic reasons, but outside their sort of core competency. And it'll be interesting to see whether they can maintain and bring the mining focus to not only have access to the metal, but to do that efficiently. But we'll certainly see how that plays out. Moving to ESG, it's almost impossible to speak about any aspect of mining in 2021 and into 2022 without talking about ESG. And certainly we see it's not just a mining phenomenon, but what we see certainly in my practice is you really can't do an M&A deal of any size without having at least some type of ESG narrative. It's about obviously what are you buying, what are you paying, why does it make commercial sense, but it's always now also why does it make ESG sense, what is the improvement there. And certainly we see commentators look at deals increasingly as a result, or focusing on their ESG credentials, and that from all indications will only grow as next few years go by, both from a financial markets perspective and a broader public sense. And that's really one of the things that has accelerated in pace coming out of the pandemic. Kate, I'm going to start with you because I know that you have a lot of expertise and some strong views on these types of subjects. I'd like to hear about how you think about it and what you think are the most important messages and the most important things when you are planning a new deal and then you are announcing it in terms of how the market will react from an ESG perspective.
Yeah, thank you, Mike. And as you say, it is a subject very close to my heart and certainly a topic that you can't avoid these days. Just as a passing comment, I think the mining sector has been reasonably well focused on ESG without calling it ESG for a number of years now. I mean, I think it has been a base case for any investment that you would have a fulsome environmental impact assessment and a social license to operate for a while now. But I think in terms of the complexity of understanding those risks, that has certainly stepped up a notch. So I think this is a learning curve for many companies, and one that we as an investment fund have been focused on for many years now. But we see now awareness sort of from companies of all sizes that this needs to be at the core of their strategy. And maybe my first comment would be, just because you're investing in battery minerals does not mean that your deal has good ESG credentials. And maybe I'm stating the obvious, but there seems to be a perception that as long as you call yourself a lithium company or a battery metals company, that you'll automatically get the green light from investors. I think investors are becoming more sophisticated. Banks certainly are more sophisticated, and PE is more sophisticated than that. So that would be my first word of warning. And just transforming your website to use an electric vehicle on it instead of a mine, again, is sort of greenwashing of the highest order. And we look to everyone to raise their game a little bit in that respect. On the ESG due diligence side, again, I think there are now a number of frameworks. Perhaps that in itself is causing confusion. Companies, are not mandatorily reporting against their ESG standards or against global standards as yet, which means the variability and consistency on the data side is very difficult for us to ascertain. There are a number of good ESG ratings providers, but the coverage of those is patchy, to say the least, when you get to the mining space. And so often, an investor will be doing its own ESG due diligence, which is going to be a lot more detailed, I think, in any respect. And then, I think my guidance for the companies would be you need to get on the front foot on this. Yes, there's a myriad of acronyms, SASB, TCFD, to say the least. These things are moving and changing at tremendous pace, but it is the burden is on the companies to get their head around these in advance before they become mandatory. And from a finance provider's perspective, this is the bare minimum for a company to understand the structures and be able to explain how they understand the ESG risks they're facing, whether they're climate or biodiversity or water, for example, a big one, and obviously the copper space. And then, we're happy to work with companies that may not be as far along on the ESG journey as others. That's actually a source of tremendous value, I think, these days, and one that an investor with the right credentials can assist companies to navigate. But, we saw at COP26, people are focused on standardized ESG reporting, which I think is a tremendous initiative. That will enable us to look at financial reports and understand how the ESG criteria are impacting the financials as well. But I do think, unfortunately, that's about at least 2 years away from that being, a global standard reporting under IFRS. So for the time being, I think, people are just going to be scrutinizing these so-called ESG deals with a very close lens. So I'll pause there.
Well, thanks, Kate. That's sobering. I think the one point I'd like to make coming out of this is that there's been a lot of focus on mining companies and their ESG credentials, and I think this is actually an area where mining has contributed to the broader discussion in a richer way. It is, after all, the mining companies and the mining sector that have had a lot of the most direct impacts on surrounding communities and environment. And this has been going on for obviously since the nature of mining. And what that's meant is mining companies have been actually dealing with and managing these issues far longer than a lot of other industries which are more new to it. And I think there's been a lot of learning that has come out of mining that has helped the other industries come through. And I think that is worth recognizing the contribution that an industry that's often criticized for ESG issues has actually made to the broader ESG discussion. I'd like to turn to Ross. Ross, when RCF is looking at opportunities and in fact managing its existing portfolio, how are you applying ESG thinking to that? And how would you say that's changing the way that private equity has operated in the past, if at all?
Yeah, Mike, it's an important question. I think, first of all, I think the mining industry has led the way in a lot of ways when you think about the need to follow equator principles, World Bank guidelines on responsible investing, then evolving to UNPRI, the responsible investments protocols. I think we've actually done a pretty good job. The thing that I'm concerned about when I'm out fundraising, meeting with potential investors that put money for us to invest, most of them don't know anything about mining. They are family offices, foundations, endowments. What we have to do is we have to go out and explain how we're investing responsibly, how we're following guidelines that will responsibly manage their money, and then we have to in turn convey that to the portfolio companies we're investing in and work with those portfolio companies. Many years ago, we actually brought an ESG specialist in-house that basically sits there on various committees within our portfolio companies to manage their ESG protocols, manage them through not just permitting, but it's that whole social license to operate. And we found that to be extremely valuable in terms of having in-house expertise, not relying on outside consultants, having a person that actually sits on the environmental ESG committees of our portfolio companies, thinking about it from our investors' perspective. Again, investors that know very little about mining and ensuring that their money's being well managed. So Mike, it's such an important part of what we do. We do report, we are signatories to the UNPRI, so we have to put out an annual report of our investments, which means our portfolio companies have to report to us in order to do that. And so, to Kate's point, standardizing these reports over the next few years is increasingly important, but it's something we've already been doing. It's something we've already started doing. We just have to get better at it, and I like the idea of standardizing it more and more over the coming years. But again, it's one of these massively important aspects of what we do and what our investors look to us to manage.
Well, thanks, Ross. I want to turn first to Mark now. And Mark, I'm going to ask you to comment a little bit on how you see it from your portfolio manager and your fund management function, and what you are looking for as an investor. And then we're going to turn to Pascal, and we're going to ask him for his perspective on how this is shaping the deals that he's been working on over the last few years. It's been different than before. But over to you, Mark, first.
Yeah, hi there. Well, I think, ESG is front and foremost in our investment process. I mean, it has been for a while, but a few years ago, we actually started to formalize it and segregate it from normal risk management. And as some of you may know, we, with a lot of our investors being based in Europe, and Europe having its own sustainable finance disclosure regulations, that basically forcing investors to take into consideration ESG when they make investment decisions. It was a perfect environment for us to put a framework around what we were already doing. And we actually ended up being, I think, the only mining investor that became Article 8 compliant, which is a higher level of integrating ESG in the investment process. So it's really front of whatever we do. We filter and score companies on ESG as just as important as we do it on valuation and other risk criteria. And what we found is that companies that do well on ESG are actually doing well on other areas of risk management, so they're actually more attractive investment opportunities. What we hope we'll see over the next few years is that the mining sector, like other sectors, will start to see a re-rating of good performing ESG companies relative to the poorer scoring ESG companies, as investment dollars chase, in a more global sense, chase the better scoring ESG companies. So I think that's a real, I think it's really good, and it's coming at the right time for the industry. The industry, as everybody's pointed out, has done great work over the last few years on its ESG. There's still a little bit of work to go, though. And I think a case in point, which might be a great handover for Pascal, is every time I see a deal, I see all the stats on ounces adding together, EPS accretion, cash flow accretion, NAV accretion, but the companies are still not putting ESG metrics in that frontline table in terms of what does this do to our sustainalytics score, for example, or what does it do to our other ESG KPIs. And I think that's the next step for the industry, and part of what the industry needs to look at in terms of deal making is, yes, we all tick the ESG boxes, but how are we going to show some KPIs to investors that translate our capital allocation decisions to improving ESG scores? And it's interesting, the only company I've heard actually quite blatantly talk about that recently was Sibanye. If you remember, Sibanye at one point said, it would be nice to have an open pit gold mine in North America, because then I could reduce my CO2 emissions, or I could average down my CO2 emissions. It's the only time I've ever heard a company talking about improving their ESG score through M&A, as opposed to just purely improving their finance scores through M&A.
Actually, Mark, one point just before Pascal jumps in, just moving to another sector, which is pretty instructive on the point you just made. Many people have probably been watching the takeover battle in North America between Canadian National and Canadian Pacific for KCS, which is a deal we've been involved in as well. And one of the most amazing things, so here you have a railroad deal, and you think of diesel locomotives, and you can think about the first thought about ESG considerations there. One of the big points coming out on both sides of that deal was how advantageous from an ESG perspective that deal would be by converting truck traffic to rail. In fact, even going so far as to quantify how many tons of greenhouse gases would be avoided each year. And I thought that was a very interesting way, right in the deal announcement press release, to really focus on that issue. And certainly, if railways can do it, mining companies would be able to do that also. Um,
Yeah.
Sort of part with that observation and challenge, Pascal, how has the ESG lens, from your perspective in putting deals together across a broad variety of companies, how has that actually affected the way deals are done and the way they're rolled out?
Yeah, thanks, Mike, and I think also to echo or follow up on what Mark was saying. I think definitely what we see is that in M&A transaction, clearly acquirers will look at the targets and how they will evaluate the ESG performance of the target is largely driven by how that company, how the acquirer is performing itself, and how are they reporting against their objectives themselves. So, I mean, I have seen situations where where certain companies were very happy to look at a target and pursue that acquisition, and other companies have actually said, for us, from an ESG perspective, that's not something we can do. So we do see that, but I think it's largely driven by the standards that the companies are implementing themselves. And like in any industry, there are mining companies that are more far advanced in their thinking with respect to ESG, and there are companies that are not as advanced, and that definitely plays into M&A. What I've not seen so far is, I'd have to say that most of the M&A situation, companies look at it and kind of see rationale in that, we want to add nickel production. This is low cost nickel for us. It works. That's the main. It's accretive to our cash flow per share. It's accretive to NAV per share. Therefore, that's why we would do it. And by the way, yes, it fits all our ESG criteria. Therefore, we can do that acquisition. I've in terms of people making acquisition to say and justifying it primarily, or maybe not primarily, but justifying it because we're acquiring this company because it improves our ESG performance. I'm not sure that we've really seen that. I don't think that the industry is there. And at the end of the day, I don't think it'll ever be solely that, right? Like, someone is not going to buy additional copper production because it's carbon neutral if it's not a profitable mine. So, both will remain important.
Yeah. Well, thanks, Pascal. We're going to go on to the last point, and we're going to make it a bit of a lightning round. And that is, we've seen, certainly in our practice, increased activity by Chinese investors over the last year or so, including in the Canadian market and the Australian market, where relations have obviously been frosty. And obviously there is a challenge with the U.S. relationship as well. But we're seeing these transactions for large companies like Zijin. Looking at Neolithium, we had a number of Chinese competitors looking at the Millennial Lithium. We have a deal with Chifeng Jilong in the market, and a bunch of others. And it's sort of interesting that these have come up in the last year, and interesting to see whether that's going to be a trend of increased engagement. It certainly is occurring against the backdrop of increased national security and foreign investment regulation in the West, especially when it comes to critical minerals. And I'd like to just do a really quick round robin for each of your impressions on that. I'm going to start with Ross.
Well, look, we've certainly been involved with a number of our portfolio companies that have been attractive and have been approached by Chinese buyers. I'd say that the Chinese buyers are very active. There's this massive demand for, I think, for Chinese companies to expand outside of China. So no question, it's going to increase. It's going to continue being strong. But I'd say the flip side is there's a lot of concern about the Chinese buyers taking on critical minerals in various countries. And I think the opposition and the balancing there is one that we can't ignore. And we've got to be responsive to host countries. We're involved in countries all over the world, and a lot of those countries want to really manage where their critical minerals are going. So it's going to continue, but I think slowly. I also think closing on deals with the Chinese has been slow. It just tends to take a lot longer, and so that opens up opportunities for non-Chinese buyers, I think, to take a hard look and evaluate acquisitions alongside. So, yeah, no question they're here to stay.
Thanks, Ross. I know we're just at about our time. Just 30 seconds from each of Pascal and Mark on any of their last thoughts on this question.
Yeah.
Pascal?
Look, I agree with what Russ is saying. I think, Chinese mining companies are continuing to do outbound investment, to do investment outside of China, to be looking for those critical minerals. If I reflect on, I started I've been at BMO for 15, going on almost 15 years now, and if that interest from Chinese companies has always been there. If I reflect on what's really changed over the last few years, is I think the geopolitical aspect and the hesitancy of Western government to welcome Chinese investment in critical minerals, and Chinese by therefore shifting their focus to other jurisdictions because they don't feel welcome. That's definitely something that's been increasing, and that's kind of changed over the last 5 years. And today, I don't see a Chinese companies actually going aggressively for any critical mineral in a country in the Western world.
Thanks, Pascal. Last word quickly from Mark, and then we'll wrap up.
Yeah, so just on that topic, it doesn't surprise me that they're so active, and in fact, you could even question why they're not even more dominant. If you consider the sheer volume and dollar value of minerals consumed, converted, and produced by Chinese companies and China, it's it's not surprising that they're so active and across the spectrum.
Great. Well, thank you very much. Obviously, a lot going on in the M&A space. Thank you, everyone, and look forward to being in person with you next year.